Recording in progress.
Good afternoon, everyone. I am Shri Raja Murthu Sharma, the moderator of this webinar. We are dedicated to welcome you all to this webinar, which is being organized by CP Committee of ICI. Please block your calendar for CP webinars on Wednesday and Friday. It is my pleasure to be a moderator for the webinar on formats of financial statements and applicable AS on non-corporate entities and recent India AS amendments. In a short while, we will start this webinar. First, I would like to tell you about the CP committee. In today's ever-changing professional scenario worldwide, the biggest challenge the professional face is how to stay on the top of their game while adapting to the new requirements and norms. Therefore, it is imperative to aim to be up to date to offer unique guidance, influence others with their innovative approach and expertise. It is also vital to stretch old ideas beyond traditional boundaries to create new perspective in the context. CP facilitate professionals to maintain, improve, broaden their knowledge, skill, and expertise required to be achieve their professional goal through webinar and seminar. The program for this evening is follows. We have two sessions of 1 hour each, and the topic are: first topic, non-corporate entities, standard format of financial statements and applicability of accounting standards. And the second topic is recent India's amendments. Your speaker will talk about the above mentioned two areas of professional interest. Now we start your first topic. In our first topic, the speaker is CA Anil Mathur sir. He is over 47 years experience in direct and indirect taxation, audits of banks and corporates, NCLT matters, forensic audits, international taxations, FEMA, arbitration, and management consultancy. He has advised on overseas projects for pharma research and manufacturing units in Sri Lanka, Dubai, Georgia, and Singapore, and contributed to drafting BER Acts and rules for the government of Rajasthan. He has served as independent director of Rajasthan State Road Development and Construction Corporation Limited 2016 to 19 and was member of the State Road Funds Development Management Board 17 to 19. He has been deeply involved with ICI, contributing to key guidance notes, audits, quality initiatives, and publications, and is a regular faculty and editor for professional forms and journals. Now I request CA Anil Mathur sir to start the session.
Thank you, moderator, Mr. Raya. Good afternoon to everyone. The chairman and vice chairman of the CP committee in absentia. At the outset, let me congratulate to the CP committee for organizing these regular webinars on every Wednesday and Friday on contemporary subjects. And today's topic that has been assigned to me is non-corporate entities, standardized formats, and applicability of accounting standards. This is a comparatively new concept, and it's a very recent changes phenomenon applicable for this current financial year. And I will just go by. I'll just share my presentation with you. These standardized formats and financial statement of non-corporate entities and applicability of accounting standards. Primarily, this covers three aspects. One is audit, another one is accounting standards, and third one is financial statements format. As you know, the audit is already there because we have got the tax audits and everything applicable for non-corporate entities. Accounting standards were also made mandatory effective 2020-21 in case of non-corporate entities, subject to certain limits which were there. Accounting Standard Board had come out with this presentation. And the latest one that has been now done is we have prescribed financial statement formats for non-corporate entities. So these three aspects are there. These standards are not taking up because it's primarily tax audit, which everyone is aware of. And in case of a trust or something, special formats, if they are there. So what basically led standardized formats for non-corporate entities, the objectives that were there, because we didn't had any specification as regards format of definite touch and the preparation of financial statement of the NCEs. Another aspect, their objective was that obviously it enhances the quality and compatibility and comprehensiveness of financial statements, and as well as to provide authoritative guidance to members by our institute. Once you have got formats in a special formats applicable uniformly to all entities, so these entities can communicate their financial performance and position in standardized formats, enhancing their compatibility. And of course, apart from the corporate entities, these non-corporate entities also have exposure to banks and lenders and everything. So that the trust of investors and lenders and guarantors in regulated framework of reporting information was one of the key objectives that was thought in terms of providing standard formats for non-corporate entities. Of course, as you know, most of our MSME enterprises are non-corporate entities. Bulk of business in a small segment is also carried out that. So the need was felt that the user of financial statements in case of a non-corporate entities should be similar to at least or comparable to corporate entities, because information in need is somewhat at par with the corporate investors also. So, as you are all aware, that financial statements of corporate entities were specifically provided in the Companies Act, Schedule 3 prescribes format of balance sheet, statement of profit and loss, cash flow statements, and notes on accounts. Because these are specified formats under the statute of the Companies Act. In the present scenario of planning uniform financial statement non-corporate entities accordingly the need of hour because of the comparativity presentation and their use. As you are aware, the size of financial and economic activities of non-corporate entities have also grown over a period of time, particularly with the rapid growth in infrastructure sector, as we notice that a lot of road constructions are going on, NHA. So for that purposes, part of the work has been also taken over by these non-corporate entities, and their size and economic activities have tremendously grown over a period of time. So definitely a need was felt at the institute's level to draw a uniform financial statement for these things. And with this background, the Accounting Standard Board of our institute had issued a technical guide on financial statements of non-corporate entities in June 2022. As you know, the technical guide is always a recommendatory one, and it had recommended format of financial statements of non-corporate entities in order to enable them to standardize the information to be presented in a financial statement of non-corporate entities. So in June 2021, the first step towards standardization of format was taken up by the institute's accounting standard. This technical guide, which was in June 2022, has been now upgraded in 2022 to 23 August in the form of a guidance note on financial statement of non-corporate entities. This guidance note has been issued in August 2022, and the once the guidance note is there, then this technical guide gets superseded. So the non-corporate entities, if they follow high reporting frameworks, financial statements represent transactions, they become more reliable, complete, and comparable. And with this background, the Institute of Chartered Accountants of India, through Accounting Standard Board, had issued the guidance note on applicability of financial statements, standardized formats, and accounting standard, which is our main topic of today's date. As per this accounting guidance note, these is applicable for financial statements prepared for the fiscal year 2024-25. That means any accounting period which is beginning on or after 1st of April 2024. So that is the base corporate entities are required to be prepared. What is expected that these entities should align their reporting practices with these new directives. So in order to make compliance and consistency and compatibility and easy and at par with industrial norms. This compliance is expected that these non-corporate entities would adhere to the prescribed formats unless specific other provisions are mandated in respect of them. As you are aware that as per Bombay Charitable Trust Act, it has a specified format for charitable organizations which are registered in the state of Maharashtra. So those formats are already there. Otherwise, the for others, and to some extent, even certain government accounting bodies, they also have their own formats. Primarily for rest of the non-corporate entities, the guidance note has prescribed formats of financial statements. The basic objectives of this guidance note is that it has prescribed a uniform format for non-corporate entities' financial statement. The first and foremost is standardized formats. The moment you have got standardized formats, it helps in enhanced reportings because then it boosts comparability, overall quality of financial reporting gets enhanced. The moment you have got standard formats, the transparency and quality in financial reporting, the consistency of applications comes out because now we have got a consistent uniform applicability prescribed for financial statements of non-corporate activity. As I've already stated that the previous guide stands superseded once the guidance note comes effective from financial year commencing on 1st April 2024. So any entity which has its financial statements from calendar year from financial year 2024-25 has to follow this guidance note, or any entity which commences business after 1st April 2024. This guidance note is applicable for period beginning on 1st April 2024. However, there are certain exclusions because it's not applicable on LLP, for which institute has already issued a separate guidance note, which may be taken care of while looking at, although the formats are there in LLP Act also, but we have, institute has also issued a separate guidance note. It applies to all other non-corporate entities which have a uniform financial reporting, including business entities as well as non-profit organizations. So that was the scope of it. As we have got, if you look at the practicing scenario, we have got a large number of individuals or smaller firms across the country. Similarly, this non-corporate entities also has a wide spectrum of entities. All business professional entities other than company and LLP are considered as a non-corporate entities. I mean, all business entities other than company and LLP for the purpose of this guidance note are considered as non-corporate entities. What one can visualize a number of non-corporate entities. It can be in form of a sole proprietorship. It can be a HUF, Indo-Divided Family. It can be partnership firms. It can be AOPs, BOI, resident welfare associations. It can be society and trust. It can be statutory corporations, autonomous bodies, local authorities, or any entity engaged in the business professional activities other than companies is called non-corporate entities. So we have got a large number of entities which are to be covered by this standardized formats of financial reportings. As we know, the most of the MSME business is carried over either by partnership firms or sole proprietors or AOPs in case of a building contract, etc. So all these entities are now mandated to follow the guidance. What basically are PAN financial statements for non-corporate entities? They are the balance sheet, which provides us a snapshot of assets, liability, and equity at a specific point of time. We have got a statement of profit and loss. Cash flow statement is also prescribed, and notes on accounts. Like corporate sector, I have our balance sheet, statement of profit and loss, and notes to accounts. This is what our guidance note on non-corporate entities also envisages. Main point that one has to bear in mind as far as format of financial statements and instructions for its preparation are concerned, they are almost what you will find in Schedule 3 of the Companies Act. So, framework of financial statements primarily based on Schedule 3 of the Companies Act with suitable modification is applicable to non-corporate entities. Cash flow statement, although part of financial statement, is primarily not required to level 2 to level 4 non-corporate entities because there are 4 levels which has been prescribed, which will come later on as for the level is concerned. The level 1 is for the highest bodies of non-corporate entities on which the cash flow statement is applicable. Otherwise, from level 2 to level 4 of non-corporate entities, the requirement of preparation of cash flow statement is not applicable, primarily for the reasons that accounting standard 3, the cash flow statement is not applicable on these entities. It is also expected that the financial statements will give a true and fair view and will comply with all applicable accounting standards which are applicable on these non-corporate entities. As I already mentioned, the Accounting Standard Board has prescribed accounting standards applicable to non-corporate entities also effective from 1st April 2020, and all accounting standards which are there are applicable, subject to certain conditions and relaxation provided thereon. However, if a compliance with any statute or accounting standards requires any change, the format as per accounting standard or that statute would prevail and the formats would be modified accordingly. The formats which have been prescribed, suggested by the guidance note, would be suitably revised if the accounting standards or any statute under which they are required, like I mentioned the Maharashtra Charitable Trust Act, which is in my knowledge. There may be some other also. So that those would be, of course, will prevail upon. Look, similarly, because owner's fund and liability is the first line item in case of a balance sheet. So the suitable line items can also be changed because association of person would not be owners. So you can change them to terminology to member fund in place of owner funds. Disclosure requirement as per Schedule 3 of the Companies Act also is additional and not in substitution to the accounting standards or statute. So whatever the disclosure requirement has been provided in the guidance note is in addition to the accounting standard and what is required in the statutes. Notes on accounts is also an integral part of the financial statement, and they shall contain information in addition to the financial statement by way of narrative description or disaggregation. Means the face of the balance sheet or face of the statement of profit and loss account is there, but the detailed information like Schedule 3 would also be provided as far as concerned in respective notes which are there. Another important aspect that one has to consider for preparation of financial statement, that concept of operating cycle is also here, like in the Schedule 3. We have got a 12 months operating cycle that has been considered for providing preparation of these financial statements. And of course, the DTA and DTL is also there. One may argue that if you are following the depreciation as per income tax only, there may not be applicability, but yes, AS 22 being applicable on non-profit entities, the PTA detail liability has also to be considered. The guidance note has provided a model of balance sheet and a statement of profit and loss account in the guidance note itself. It has also provided an illustrative um, financial statement at the end of the guidance note, which may be referred to it. I will just summarily discuss a few important parameters of financial statements. So we start with owner's fund and liabilities, unlike in Schedule 3 with the share capital equity and liability, we start with owner's fund. And then owner's fund has two parts. One is owner's capital account and reserves and surplus. So under these two broad parameters, one has to provide the details of funds and reserves and surplus. If you just have a look that the owner's capital account is also again subdivided into two reporting requirements. One relates to partners capital account and another one is in respect of current account. As you know, the many of the entities, they have got their fixed capital accounts and the regular transactions are carried out through a current account. So the balance of the current account, if an entity is having a partner's current account, has to also to be shown separately here. The reserves and surplus again has got two probably general reserves and other reserves which are there to be then, and undistributed balance as far as uh, surplus of profit and loss is there. That has to be reported here. We have got similarly we have got non-current liabilities and current liabilities. So these are primarily the formats for balance sheet of the liability items. The specific things that one has to look for it, I will just cover one or two subject to availability of time. That the owner fund is like what we have got is capital balance. So by way of note, you have to provide the opening balance of partners capital account, the capital introduced during the year, the remuneration that was paid to the partners, interest that was given to the capital account, withdrawals made by them, share of profit or loss in percentage as well as in amount, and what is the closing balance. So these information as regarding capital account has to be provided by way of a suitable note. Reserves and surplus, basically you can have a capital reserve. These non-corporate entities are also entitled for revaluation of their assets. So revaluation reserves can also be there and other reserves. And finally, the undistributed surplus, if that has not been credited to the partner's capital account. Similarly, this non-current liabilities, again, they have got the same thing. You've got a long-term borrowing, term loan from bank and others, related party reportings, whether the loan is secured or unsecured, what are the if the guarantee has been given by partners or others, what are the terms of repayment, they all have to be separately shown by way of note. And in case of a trade payable, we have to see whether the MSME trades are there, principal amount as well as the interest element on that. So primarily, what I mean to say is the requirement are streamlined as much as possible from Schedule 3. So those details in form of notes is to be given. Now the assets have got again subdivided into non-current assets and current assets. The non-current assets, like our fixed assets, we have got PPE and intangible asset. Intangible asset, we have got a CWIP and intangible asset under development. All these requirements are similar to our corporate clientele also. Then non-current investment would always include the balance of fixed deposits, which is in excess of 12 months period. That would come here. So one has to keep in mind this particular aspect, because these are the face of the balance sheet. Detailed things come in the note. And as far as this non-current investment is there, the investment, whether it is in a trade investment or whether it is others investment, has to be separately shown and further subdivided into the property, equity, mutual funds, debentures, partnership firms, whether it's a quoted investment or unquoted investment. All those things are required. As far as trade receivable is concerned, the bifurcation is for more than 6 months and others. And alternately, the requirement is also to disclose whether these trade receivables are secured, unsecured, or doubtful. Cash and bank balances, similarly, we have got a cash and cash equivalents, balance with banks, and they are there. And other balances of the banks, if you have got earmark balances or you have provided a guarantee or you have margin money, etc., they have to be separately shown. So, and of course, the notes are there. This is the basically format which has been suggested by the in form of a guidance, and a detailed checklist or has been given at the end of the it. The statement of profit and loss for the income side has three parts: the revenue from operations, other income, and the total of these two. So revenue would have sale, what has been stated in the general explanation, the sales less excise duty, which is no more applicable now. So sale from a product and sale of services has to be separately depicted, as well as the other income, whatever you have got is maybe the interest or something like that. Then in the expenses, what is specifically to be noted is that if the item is 1% or more of your total expenditure, then this has to be separately shown. So the similar thing is there. So we have got depreciation, employees benefit, finance, other expenses, and the total of expenses. It is all there. We have the concept of exceptional items, extraordinary items, also in the non-corporate entities also. The interesting point to be noted is that in column 9, we have got a partner's remuneration, profit before partner's remuneration, and tax. So partner's remuneration has been shown as a separate line item as far as there. So discontinuing operation, profit before tax, profit tax expenses, current years, deferred tax years, and profit or loss at the end of the year, which is transferred to the capital account. So these are basically the on face, because what the USP of this statement of profit and loss is specific to the non-government entities, that the partner's remuneration has been separately highlighted. So, and now the next step is cash flow. He said, accept the mandatory level of one is others are normally exempted from preparing cash flow statements. Now, the notes on accounts, because the note numbers are there and the additional information is provided in the notes on accounts. So what are the main disclosure requirement for the notes of account is concerned? We have got a significant accounting policy that has to be mentioned, and that has to also take care of the accounting standards which are applicable on this particular entity. So significant accounting policy should always be in line with the accounting principles and methods and what are your accounting standards. Any information which is specifically mandated by accounting standards, that has to be separately disclosed. And the sub details of the face items has to go by way of narrative explanations, and all the disclosure of items which are normally not recognized in the main body have to come in form of there, including the contingent liabilities, because now for the non-corporate entities also, it is expected that contingent liability and commitments are part of our notes and accounts. Three form sub-limbs have been suggested. One is the claims that has not been acknowledged is debt. Guarantee is given by to third party debt or for the performance that has to be separately shown, or any other monetary obligations which are there but have not been crystallized or converted into liabilities. So contingent liabilities are also a part of financial statements as far as the non-corporate entities are concerned. Now the question that may come is whether we have to show the full value of transactions in rupees and paisa, or there are any options as far as rounding are available. Yes, guidance note suggests that you can have a rounding of option, but the word used is may, so it is not mandatory to do it. But once whatever you have finalized, whether you are giving a full value of figures or you are giving hundreds or thousands, that has to be consistently followed. Unlike Schedule 3 of Companies Act, which from 2021 uses the word shall, this guidance note for non-corporate entities for the time being is using the word may, and rounding of guidelines are like same. Income which is less than 100 crores of rupees, the rounding can be done in nearest 100, thousands, lakhs, or millions or decimals. Or if the income of the entity is more than 100 crores, then to the hundreds and thousands are eliminated, then lakhs, millions, crores is the new one additions or decimal there. In place of millions, we have got the word crores. The another very important point that one has to keep in mind as far as the non-corporate entities financial statement there, that like corporate entities, previous year figures have to be provided. And previous year figures must be presented on all items, including notes, except for the first year. If you have got an existing entity which is already in existence from financial year 2021, 22, 23, these previous year figures for 24-25 has to be accompanied by previous year figures of 2023-24, excepting if the entity's business has commenced in the current financial year also. This, of course, being a new thing, some challenges are also expected, but benefits are more than the challenges. The challenges we are capable of overcoming. The benefit would be because now there would be uniformity in financial statements. So once there is a uniformity, the transparency automatically comes in, and the more of the transparency, the stakeholders get more what is it, faith in the financial statements. The benchmarking becomes easy. Of course, the credibility also boosts up. So once we have got all single format available for all non-corporate entities. So comparatively, analysis of entity wise, business wise, segment wise, whatever you want to do is that can be taken care of. Yes, of course, we anticipate certain challenges. Some of them maybe because there is an awareness gap. Smaller firms, smaller businessmen, they are not really adapt to changes for very in immediate future. Then micro entities, they don't have a proper accounting system, so maybe proper accounting staff, infrastructure problem is there. Of course, training needs has to be provided as far as this preparation of notes and accounts and everything is there. And as a human nature is there, that there is once there is a new thing, then there is always a resistance to change. But yes, it has to be overcome. We have to encourage our clients to prepare this. All these things has to be taken care of. So this part one was what has been standardized formats of non-corporate entities. Those said by the guidance note, effective from 2024-25, applicable to all business, industrial, and carrying out activities by all types of non-corporate entities, be it proprietor business, partnership, trust, firms, whatever is there, resident welfare societies, joint ventures, and all those things. The other part that has been assigned to me is the applicability of accounting standard on non-profit entities. The accounting standard normally, what does it do is it provides a laid down recognition, measurement, disclosure, and presentation requirement for preparation of a financial statement of an enterprises. So it recognizes, it measures, it discloses, and it gives a how the seems to be presented in financial statement of an enterprise. These are the basic objective of accounting standards. Accounting standard for non-corporate entities, as already told, has been made applicable earlier from 2020-21 because the moment you have an accounting standard, there is a common language, there becomes a transparency, confidence of stakeholders always high. They are comparable with each other so that you have got a option to choose amongst the best. So these are always well. India has always been following 3-tier approach for accounting standards. We have got Ind AS, the part of which would be taken up by Mr. Chintan Patel. What are the changes in Ind AS? The second topic of that. Ind AS are, of course, mandatory for large public companies, listed entities, and NBFCs, and they have been aligned with the IFRS. So the Ind AS are applicability is different. Then we have got accounting standard under the Companies Act, which are applicable for companies not covered by Ind AS also. And these standards are quite robust in by themselves. And then AS issued by the Institute of Chartered Accountants, especially for non-corporate entities, all standards AS1 to AS29, which are there. And they provide guidance for diverse corporate, non-corporate structures like partnership firms, proprietors, business, trusts, EOPs, etc. So accounting and standard applicability, we have got we have covered a long way since last many years as far as the applicability of accounting standards concerned. So effective from 1st April 2020, what were the accounting standards are applicable to the NCs also. We have got total number of 29 accounting standards which the IC has issued, and for their applicability, we have classified them into 4 entry levels. The classification system will definitely will vary with the compliance requirement. What is your entity level? Whether you have got a level 1 or whether level 2 or level 3 or level 4. So depending upon that, it has been the applicability of accounting standards has been suggested. The purpose, as we all know, is uniformity and entity engage in commercial, industrial, or business activities. But if you're for this non-corporate entities, even if a very small portion of the activity of entities is considered as a commercial, industrial, or business, the accounting standard would apply for all activities, including those which are not commercial, industrial. Means if a part of a business of an entity, which is a non-corporate entity, does not cover commercial, industrial, or business aspect, but some part covers it. But then for all of its activities, the accounting standards which have been specified would apply to it. An exclusion from applicability is permissible if no part of the activities or entity is commercial or industrial. If you have got a zero in commercial or industrial use, then only the applicability would not be there. So for the purpose of non-corporate entities and its applicability, the Council of Institute of Chartered Accountants in March 2021 decided that they should be made applicable to non-corporate entities also. And for the purpose of applicability of these accounting standards, the non-corporate entities were classified in 4 levels. Level 1, level 2, level 3, and level 4. Level 1 is large size entities. Level 2 is medium size entities. Level 3 is small size entities. And level 4 is the micro. So level 2 and level 4 together are called MSME enterprises. The welcome Chairman of CP committee, I think, is joined it. Sir, with your
Namaskar,
permission,
sir.
I'm continuing.
Namaskar, Mathur, sir. How are you?
Fine, thank you, sir. With your permission, I'm continuing.
No, sir, just a question. I just want to raise up one question, sir. Rajaji, namaskar. And
Pranam.
the team tag and team CP, namaskar. Anil, sir, you just have described that format part, and you have wonderfully described that. I just want to know that whether if the assessee or the auditee does not come with the prescribed formats by the ICI, what is the option available to the chartered accountant? That is very important question and moot question, sir, because all the chartered accountants of the Mofussil areas, which are very small
I
cities.
knew that I was expecting this question from a large number of members and thought of diverting the answer to you. Because you being a council member is in a better position to answer it. But yes,
And
to some extent,
yeah, please, sir.
Look, sir, the accounting standards are applicable on non-corporate entities. So and they are mandatory. So if you don't follow accounting standard, they are there. And non-following of guidance note, of course, guidance note are always considered to be recommendatory. But if statutory or some compliance is required as far as the guidance note are concerned, then I think part 1 of second schedule of Code of Ethics also comes into operation. Yes, guidance note, of course, they are recommendatory. But in here, it's a typical question. Situation, because you have got accounting standards applicability. Accounting standards are mandatory to be followed. If the assessee or chartered accountant is held that he has failed in his duty in non-reporting the accounting standard, then what happens, sir? The same problem would come. As far as the format is concerned, we can say because this was a guidance note, it is a transitory period, it is a recommendatory in nature. So it is a situation
what was
between
my question exactly? That accounting standards are being followed by the clients, and auditors are taking that care since long, sir. Whether accounting standards are not applicable from 2 years, 3 years, those are applicable since long, even on the non-corporate entities. But what about format? The clients are not agreeing to follow the format. They say that it is not, our chartered accountant don't have such time to convert those formats in the new format. So just can they go with some that disclaimer or some remark that they has not fallen subject to this, the true and fair view is there?
It is always advisable if the desired format is not there, then it's always advisable to give an qualification for that, sir. It's always advisable.
Okay, sir.
Because it's between institute and a member only. Because we can't do anything on for the enterprise.
Right, sir. Very, very rightly explained, sir. And second thing, sir, what I want to just bring just to bring that this four level type of things, sir, perhaps it has gone. Now they have changed it to some extent. There are only 2 levels: the micro and small or other. So I think level 4 and level, right, sir? Level 3 and level second.
Level second, 3 and 4.
Level first is the large entities, and the another is the micro and small entities. All entities are there, sir.
Yes.
So second, third, and fourth are now, I think they have been merged in one only, and there are some concessions. So I think you will take in your next presentation.
Because our guidance note has provided a table of applicability of all accounting standard on level 2, 3, and 4 entities. So on some
they have. Okay.
Have they recently come
out
with
what I understand, and second, 3 and 4 now micro and small, and the one is the another one of large entity. This is there as of now.
2, 3, and 4 are collectively known as MSME enterprises now.
Yes, sir. Right, sir. So, sir, continue, sir.
That relaxation,
question, because that question is very important. Relaxation of
relaxation is already
second
there,
to fourth.
sir.
Yes. This is correct, sir. Cash flow. Yes. Right, sir.
Yes, that
Right,
is
sir.
already there.
Okay.
That is already there.
Okay, sir.
And these are the accounting standards which all 29, whether they are applicable or not, I will not go through the entire details. You have the long list. AS1 is everybody knows is accounting policies. AS2 is valuation of inventories. Third is cash flow. It is applicable to some extent. It is whatever has been written is applicable with disclosure exemption. That means those particular paragraph or accounting standards which are there are not applicable to these entities. Primarily 1 to 10 are more or less, 1 to 9 are more or less applicable to all one, excepting AS10 with additional disclosure requirement. Property, plant, equipment is not there. So these all 29 standards. I've just prepared a chart that even in the guidelines note has taken care of it. But the thing that the last thing that I wanted to bring to your notice was if an entity is covered in level 2 or 3 or 4 and is qualified on an exemption, and in subsequent period or current period, this relevant AS becomes applicable in current period, then previous year figures need not to be revised. Means if level 3 comes to level 2 or level 2 comes to level 1, then only the current year figures need to be there. And this fact that it has migrated to another level and previous year figures have not been revised, that has to be need to be disclosed in the financial statement. Similarly, vice versa, if level 1 shifts to the lower level, no exemption would be available for 2 consecutive years, and 4 to 3 and 3 to 2, so upgradation, no relaxation. Otherwise, there are. And any entity level 2 opts not to avail any exemption means if it is always suggested or encouraged to follow accounting standards, yes, you are welcome to do it and disclose that. So these are the thing, and even for the notes on accounts for MSME, I think it's always advisable to disclose by way of note the level of MSME entity or level 2, 3, or 4, whatever is your entity is there, and whether any benefit or non-compliance of accounting standard has been opted by that entity need to be also separately disclosed. So these were some of the issues as far as the guidance note was concerned, regarding format of financial statement and as well as the applicability of accounting standards. Thank you very much for providing me this opportunity, and thanks to the CP committee. I'm open for any questions later on if there are. Over
Thank
to
you so
you,
much.
the moderator, please.
Thank you, sir. Thank you. It was great session. One question is, sir, if assessee had not prepared financial statement according to these guidelines, what is recourse for tax auditor as income tax department has not prescribed instruction to follow this system?
Sir, unmute करें sir, unmute. Anil sir, unmute करें.
The chairman CP is himself asked this question, and I think the answer is already there. Yes, as far as the tax audit is concerned, you have got a form 3CB and 3CD, the prescribed format is there. But as far as the financial statement is there, if you think that there is gross violation of format is there, then it is always advisable to make a suitable note on it.
Okay, another question is,
Sir, Anil sir, if you permit, I would like to add one thing.
Yeah, sure, sir.
Sir,
You are
thank
in the
Anil,
best
sir.
position, sir.
Thank you, sir. Sir, my dear friends, I just want to say you that kindly remember form number 3CB of tax audit report and their point number 3 and sub clause A. This is very important for all of us. Whatever qualification, disclaimer or other matter we want to cover in our we should use that particular para 3 sub clause A. Important, and whatever, suppose the client has come to you without new format financial statements, then you must qualify that particular part of the non-compliance in that particular 3A. And subject to that, your financial statements may provide true and fair view. So this is very important. And if rightly said by Anil sir, that if any standard is not being followed, That is very critical point. And as a chartered accountant, we have to again qualify that particular standard which has not been followed by the auditee. I think we all were doing this, trying to complete that whether assessee has complied with the accounting standards or not since long. These are not the new thing. This is a very old thing. So if format is not there, you try to convince your client to take that particular format. If that is not there, then kindly go through with the qualification or the disclaimer, whatever you want to write. Second thing, which I want to say that in the tax audit report, although it is not part of the subject matter of the day, but just to take the time that point clause number 22 of the MSME is very important clause, my dear friends. So whenever you are going for the tax audit, kindly see that compliance of clause number 22 of MSME is being done very diligently. And very important because what requirements that particular 3CD form has prescribed for the audit is which are very time consuming. So you should give instructions to your clients. Rather, kindly go through our guidance note on tax audit. And I think page number 214, 215 are there. They have given some formats which we may send to our clients. They can complete the requirements through those formats. And thereafter, the audit work will be comparatively easy and it will be subject to verification only. So, instruct your clients to follow at least clause number 22 and some other clauses which are very important. Clause number 31, that is 2610SS, and the 2690 is also very important. So several other clauses are important. So don't worry about anything in the tax audit report. If your client is not following any accounting standard and you are after verification you are sure, then don't hesitate in qualifying the report. And believe me, nothing happens. कुछ नहीं होता है. Nothing happens to your client. But if you don't follow the standards on auditing, or if you don't see the compliance of the accounting standards, then definitely we as a professional come into soup. So what I would like to suggest that kindly give proper qualifications or disclaimer whenever you find that this particular thing has not been followed by your auditing. This is my submission. Anil sir, any other thing if you want to add in this?
Absolutely right, sir. As far as accounting standards are concerned, and sir, we have to instruct our clients, and we all know that we have to provide a significant accounting policies in these financial statements also. So as far as whatever accounting standards are applicable to that particular entities, we have to make sure that those accounting standards are covered as far as significant accounting policies are there. So whatever significant accounting policies, they have to be in line with accounting standards which are applicable to that particular point. And secondly, not directly related to it, sir, अब आपने UDIN में भी तो कर दिया ना साहब. Even in UDIN, whether your report is qualified or not qualified or clean or disclaimer. So even those are there.
I want to bring in the notice of the members, friends. Anil sir, we are taking it back because of our members have opposed. Some of the members were saying that we need some or more maturity. So as of now, for the time being, we are taking it back. I think that will happen within a few days.
It should happen, sir.
Yes, sir. It would happen, sir. So Anil sir, any other thing, sir? Any your practical experience about this format, sir? Because this is really a matter of worry, and this is the first year of this implementation. So members are really in puzzled position. So how can we help them by guiding them that don't worry and don't take tension of this?
So there is no tensions for as far as the members' knowledge is concerned. Members are well aware. The thing is how to get the best results from clients. Because what we did, sir, even in the last year, 2023-24 statements, what we did is we started giving the previous year figures there itself. So this year, for us, it became a comparatively easy task because now we have got ready-made. Because the biggest problem would be to prepare previous year figures, sir. Because the formatting and everything is done, it will take some time. The client has to be, in fact, extra effort has to go teaching the staff of the client and teaching or impressing upon the client to avail this benefit because it is in his benefit also. Even the banks are in the know of things, sir. So banks would also demand the financial statement in these revised prescribed forms. So that
Then
is
I think, sir, if it is there, then it will automatically be in the system, sir, in a year
Yes.
or 2 years.
The teething trouble would be there, but we should stick to as much disclosure as possible from the client. We have to work hard, but yes, do it now.
Definitely, sir. Raja, any other question?
One more question, sir, is whether these formats and AS are applicable to NGO registered under Section 12A of the Income Tax Act.
For trust, the formats are
Yeah.
different. For trust, the formats
Trust
are
formats
different.
are different.
Yeah.
Okay, sir. One another question is, if a sole proprietor professional firm entity is providing depreciation on WDV basis on block of assets at the rate prescribed by the Income Tax Act, as opposed to AS10, is it necessary to qualify the same in para 3 of 3CB?
What any proprietary concern can provide depreciation at whatever rate is provided because what I'm just. Can you repeat the question? Because is it for the depreciation as per the
Question
company's
is this,
act
sir,
or as per
Anil,
the
sir, question
depreciation?
is this, that if anyone is having the WDV figure only, and the requirement of the format is of the gross value, so whether it qualification is needed or it can go ahead. That is the question.
Sir, put a note to it because since the gross figures are not available, we are taking the WD figure out because it's not possible. It's not possible. Put a disclaimer on it, sir.
Great, sir. Any other question, Raja?
Yes, sir. In case where annual accounts are not legally required to be attested by a chartered accountant, but the client requests them for personal or banking purpose, is it necessary to include a disclosure of annual accounts in new format?
Once you are auditing accounts, whether it is required by not required by any statute, but not for the tax audit, yes, our responsibility shifts.
Well, rightly answered by Anil, sir. Whenever audit is there, you will have to follow because you are doing work as a chartered accountant, and guidance note is applicable on the chartered accountants.
Okay, sir. No more questions, sir.
So thank you.
Thank
Give thanks to Anil, sir. Raja bhai.
Yes, sir.
Not. I'm a part
On
of
behalf
user,
of
not
everyone in CP committee, I thank you for explaining so clearly the formats of financial statement and how they apply to non-corporate entities. Your guidance is very useful for us in practice. I also thank to all participants and organizers for their support.
And participant number is around 800, and I welcome Chintan bhai, also from the west, from the Ahmedabad, city of Gandhi. Welcome, sir, or city of Narendra Modi ji also. Welcome, Chintan bhai.
Thank you so much, Satish ji. It's always pleasure to be here when you are here as a chairman.
It's my pleasure, brother, and you have such capabilities and competence that we are always benefited by your deliberations.
Thank you so much, sir. And I still remember our personal meeting at Jaipur, and then we shared a wonderful rapport, and the way you've been doing for the CA fraternity, it's commendable.
I do, sir. I also remember that day, and I learned a lot from you, Chintan. You are really wonderful orator and having very big knowledge, like Anil Mathur, sir.
My pleasure, sir.
Over to Raja.
Before I start the second session, I would like to formally welcome our chairman, sir, C.A. Satish Gupta, sir. C.A. Satish Kumar Gupta is presently serving as a chairman of the CP committee of the ICI. In addition to this role, he is also chairman of UDI Directorate and vice chairman of the CMP for the current term. He previously served as a council member of ICI from 2019 to 22. He is renowned speaker and author specializing in income tax assessment, searches, surveys, and professional development topics like goal settings and career planning. Thank you so much, Satish sir, for being with us.
Thank you, Raja. Thanks a lot.
Now, our second topic is recent India's amendments. Our speaker is C.A. Chintan and Patel, sir. Welcomes you, sir.
Thank you.
Yes, Chintan Patel, sir. He is a CA, CPA, US, CS, CISA, USA, DISA, DIRM, certificate in India as FAFD and social audit, and is a partner at a firm located in Ahmedabad. He has authored a widely book on India S and ICTS published by Taxman and delivered over 500 presentations at seminar and conferences. He has over 20 years of experience working with SMCs and MNCs, specializing in auditing Indian and international accounting standards, ESG reporting, and corporate advisories. Now I request to Chintan sir to start the session.
Thank you so much, Mr. Sharma. I think for giving introduction, and it's always pleasure to be here when Mr. Satish Gupta ji is here. I know the person who is a dynamic, and he has a lot of I think passion to serve profession. Even though right now he's a traveling, I can see the visuals of background, and even though he's traveling, but his heart and everything stays with the members. So that shows the commitment, and these all Santa Claus members, they are working day in day out. Sometimes members didn't realize, however, whatever we get today, for that lot of hard work and support from the team CCM, from the council member, from the coordinators like Mr. Sharma and others. I think it's really, really commendable. We must appreciate their work. It should not be a case where we take them lightly. I think from their busy time, from the sacrifice of the office and family, they are spending time. So once again, sir, thank you.
Thank you, Chintan bhai. Chintan bhai, Raja Mordhwa Sharma ji is very dynamic leader of Jaipur. Presently is vice chairman of the branch and going to lead the branch next year. Very dynamic. So I think we welcome you again in the CPA committee, sir.
Hello.
And please continue with your lecture, sir. Thank you.
Sure,
Thanks.
sure.
Sign नहीं करे तो मेरे को call करो.
Great to know, Mr. Sharma. I think that my best wishes to you for doing the base for profession, and we hope to see you again at a larger forum in the future.
Thank you, sir.
So, friends, now with this brief word, let me just share my screen to all of you, and then we can again jump over to one of the most important session. Yes, I can understand that probably for all of you, the hot topic is more on non-corporate entities, because today we are in the era where everybody is struggling to identify solution to how can they comply with this requirement. However, along with this change, another change which has silently been a part of this particular profession is about Ind AS. So every industry, every company, every professionals who have been associated with respect to this Ind AS and the financial reporting part, I think this is something which is critical for all of us to know. So today I'm going to talk about mainly on Ind AS amendments. Friends, there are two amendments in the Ind AS which has been recently notified during 2025 year. So we also talk about when it's applicable. We also discuss about the reason why it has happened. However, the most important thing is that this Ind AS amendment has really made us like something where we all are trying to learn. CPE committee where is required, because the CPE committee is not only about relearning, it's also about learning new thing. And the amendment which are right now here under Ind AS, it really requires to have a series of sessions which is continue to be happening either in the GST or Ind AS or Companies Act. Now, before I talk about the Ind AS, let me just first briefly talk about why the amendment in Ind AS. In India, the number of companies which are covered under Ind AS is actually momentous. India is a country where the numbers are the biggest thing which is available. Global companies come to India because the number of customers, number of consumers which are being available in India, it is not generally available in other countries. China obviously is a populous country, but there are a lot of restrictions which is not there in India. Similar way, we also have been concerned about the amendment in Ind AS, because Ind AS is nothing but it is the IFRS version for India. When as a country we move toward IFRS implementations or IFRS conversions, at that time, we didn't adopted IFRS as such. What we did that we have some carve-outs, and therefore we don't say we are complying with IFRS. How do we mention that we are doing compliance of Ind AS? And that Ind AS is nothing but it is a 99% of IFRS. So why there's a change? As IFRS changes, there is a need to have a change in Ind AS. What is IFRS change? So IFRS primarily changes because of two aspects. First, ISB and IFSB. In world, there are two gaps which are dominant, which are talking about accounting and reporting. One is USA GAAP, US GAAP, and second is IFRS. US GAAP is also sometimes known as rule-based. I don't completely agree on that part because US also has its principles. However, it has become rule gap because they have a huge literature available, which is able to provide a lot of information on these things. So US GAAP is more like rule-based, and then is IFRS. So US GAAP is being done by FASB, that is Financial Accounting Standard Board. And IFRS is announced and issued by ISB, that is International Accounting Standard Board. ISB and FASB are working together to converge to each other because the IFRS and the reason and the purpose of IFRS is achieved only when every country in the world are on the same batch, are on the same principles of IFRS. So for that, US GAAP has mentioned that only when the US GAAP is modified to align with IFRS, similar way, IFRS should also be modified to align with US GAAP. The both FSB and ISB sit together and they have come out with the convergence part, wherein the few standard of US GAAP are being changed to align with the IFRS, and some of the part of IFRS is also modified to align with FASB. That is the one main reason why there's change in IFRS. Second very important reason is that a lot of countries in the world, they are being a part of this particular gap. Earlier was issue where the IFRS issue standard and every country changed as per the requirement. However, now it is not a case because every country has to compulsory apply IFRS. So there is also a lot of feedback and consultative approach happens in issue and implementation of standards. So amendments may also be required because of a lot of consultation happens, a lot of responses received from various parts of the world. And one of the most important role which is played by is the analyst. The analyst primarily try to see that they should be in a position to compare the financial reporting part of one company in XYZ jurisdiction with similar industry of another company in different jurisdiction. When they both are similar industry, the jurisdictions or country should not be the issue. The most important thing is that they should be comparable. However, in a lot of respect, they identified that they are not comparable because certain companies follow different principles because of lack of guidance. Therefore, there's a change in the standards. And as the IFRS changed, the Ind AS also amendment. So during 2025, so far, there are two amendments. First is Ind AS Amendment Rules 2025, where one of the most important changes on the Ind AS 21 non-exchangeable currency. And second very important amendment, which is with respect to Second Amendment Rules 2025, where there is a lot of discussions on supplier finance arrangements, current, non-current, and other aspects. So we are going to primarily focus on these important two amendments. Thereafter, so I have talked about IFRS 18. So far, India's 118 is not been notified. However, the purpose of discussing IFRS 18 is to have a glance over what may happen to the presentation model, which is going to come maybe in a couple of years as far as concerned. So let us look at IFRS 18, which provides a presentation model. And lastly, we'll have a discussions on key takeaways. So, friends, this is actually very, very like small, how important parts for companies. Primarily, we have been focusing more on India's transition. First point is on India's Amendment Rules 2025. The key points. The change is first India's 21, that is effects of changes in foreign exchange rates. So here, the most important concept that is being introduced is the currency that is non-exchangeable. I think that is what we need to all understood. There's a lot of discussion happening about in a lot of countries where the currency is not so much readily easily available. The exchange rates which are not easily available. So in certain situations where the currency is not exchangeable, how to determine? That was the issue which has been faced by many countries and jurisdictions which has responded by way of this amendment. Second, also provides guidance on process for estimating the spot exchange rate when currency lacks exchangeability. Also, it talks about the disclosure requirement, which are the new and extended disclosure required when exchangeability does not exist to improve transparency in a financial reporting. Another amendment is on India's 101, that is first time adoption of India's, which says that in case of a hyperinflation economy where a company's currency is hyperinflationary. So hyperinflationary economy where the inflation is very high. It is more than 100% in last 3 years. And there are a lot of economies in the world have been classified as a hyperinflationary economy. So in case entities in economies functional currency is hyperinflationary and the referencing of non-exchangeable currency is there. So if an entity uses a fair value of asset liability as a deemed cost on opening balance sheet due to severe hyperinflation. So this particular point was basically also covered under this particular Index 101, where it says that if an entity uses a fair value as the deemed cost in opening balance sheet due to severe hyperinflationary, then that guidance has also been covered under 101 first time adoption. So when you just look at this particular amendment, probably you may feel that this is not so much critical, so much difficult, because however it introduces a very new concepts. So we are going to talk about the new concept, which may be very relevant and important for all of us to understand, because unless until we know that the concept is already being there, probably we have failed to really look at and understand its implications on the financial statements. So the new guidance which I have introduced is it defines non-exchangeable currency. So that is very, very important thing. That is where restricted conversion to another currency. To understand a concept of a non-exchangeable currency, wherever in certain economies, the countries and the government itself does have a lot of restrictions on the exchangeability of the currency. So what happens that the exchange rate which has been derived or which has been provided by the government may not be the actual exchange rate. So if the financial statements are translated based on the exchange rate that is provided by the government, which may not be actual or real exchange rate, probably the results may not be correct. So ISB received a lot of feedbacks and queries from various persons saying that they need to provide some guidance about how to determine exchange rate. Now, why this exchange rate is relevant? I'm just trying to make it very simple and lucid way. First and foremost, India's 21 says that in case of any foreign exchange transactions, the foreign exchange transactions are required to be converted at spot exchange rate, transaction date, spot exchange rate. Also, the monetary asset liability is to be transferred at the closing reporting date exchange rate. Now, in both the cases, exchange rate which has been taken for the translation, which may not be able to provide you the real picture. So, the countries where what will happen there, what is being seen is that in certain countries like North Korea, Venezuela, Argentina, if an Indian company has investment in a subsidiary which is based on Argentina, Venezuela, or North Korea. I'm just giving you an example. I'm not coming to conclusion that whether they qualify to be the non-exchangeable currency. I think for that, when it's to do assessment, however, they may be likely to be qualified, or they may require to have additional assessment of India's amendments to see that whether they are qualifying to be non-exchangeable or not. For the purpose of a sake of understanding and explanation, let us assume that the North Korean or Venezuela currencies are non-exchangeable. With a non-exchangeable currency, however, for the purpose of translation of foreign operations or for foreign currency transactions, when the spot exchange rate has been taken, which has been declared by the government, and with the consolidated financial statements is being prepared, or wherever the financial statements even the standard is prepared. So the risk was that the exchange rate which has been taken to translate is converted into the profit or loss or the financial position for a company. However, if they really want to repatriate the fund, probably they may not be able to get the similar fund which they claim to be receivable or payable when they translate exchange rate. So what happens that a lot of companies have started understanding the issues, and they will be more happy not to have this kind of the financial statements as a consolidated in your financial statements. So probably they are trying that how can they de-risk these kind of things, and how can they ensure that they are not in the books of accounts, because unnecessarily they will have impact on financial statements which is not easily understood. It may impact the financial statements, however, they may not be correct. So the result may not be correct or overstated because of the lack of guidance. Consistency is not there. When they actually want to repatriate fund, it is difficult to repatriate. Even though when they do translation, they may realize that actual translation is different than what the action they've taken for the purpose of translation. There can be a huge black money is possible. So, for example, if I want to get the actual money, the exchange rate is different. However, if I want to get any cash, the exchange rate is different, because getting the exchange rate, getting the money in the USD or some other currency is difficult. Even though the currency, local currency is of Venezuela or North Korean of country, people have a more focus to have some strong economic currency like US dollar, and they are more confident and more comfortable to deal with in USD rather than these particular things. So these are the only indicators. So non-exchangeable by means that where the exchange rate which has been taken for the purpose of translation of a transaction date of balance sheet rate, they may not be actual exchange rate, because that is not the actual exchange rate wherein the company is able to get the result. Therefore, the analysts have approached ISB to provide guidance on that, and the agenda was taken in ISB, and then they come out with the very important discussion on concept of non-exchangeable currency. And in case it is a non-exchangeable currency, then it provides a clarification how to determine your spot exchange rate, because determination of spot exchange rate is something which is a very difficult and complex part. Additionally, it also talks about the disclosure to be provided, currency and description why it is non-exchangeable, description of affected transactions, carrying amount of assets and liabilities, spot exchange rate use, and whether it's observed or using estimate technique. So these are the disclosures which are required in case the currency is a non-exchangeable currency. To understand this point, let us have one case study. Indian parent with a subsidiary in a country X, when local currency cannot be exchanged due to government restrictions. So accounting here is that first you are to arrive at conclusion that the currency is a non-exchangeable currency. Second, if the currency is a non-exchangeable currency, that second point is to determine spot exchange rate. For determination of spot exchange rate, the India's Attorney amendments provide you the guidance how to do estimation of this particular exchange rate. Plus, you to provide disclosures of the therein in these particular things. So, to determine a spot exchange rate, it actually talks about that first you look at whether there are several exchange rate is available, because the question can be that how can you determine spot exchange rate? You may need to look at the availability of the exchange rate. There is possible that the several exchange rate may be available. In that case, you have to look at the purpose for which exchange is available and the purpose for which I want to transact or transact exchange rate. What is the nature of exchange, nature of transaction for which I have to translate? Frequency at which exchange rate is being converted. Is it converted at every day? Is it converted at every 1 month, 2 months, 3 months? The more the frequency, then it is more reliable. So if it is being frequency as a daily, then it's more reliable than something which is being provided at every monthly. So spot exchange rate is to reflect a rate at which an orderly exchange transactions would take place at a measurement date between market participants under prevailing economic conditions. So what it says to reflect at the rate at which orderly exchange transactions. So if there are no restrictions and market participants are basically involved into the arm's length transaction, in such case, what will be the exchange rate? That is where you do estimation. So that was what mainly primarily more on the currency exchangeability. This appendix which has been there under Index 21, we say there are 2 steps. Step 1 is assessing whether a currency is exchangeable, and step 2 is estimating the spot exchange rate when a currency is not exchangeable. So this is a chart which has been also been provided to provide examples and scenario in case where you have to apply this amendment. Let us now look at India's Second Amendment Rules 2025. The First Amendment was notified on 7th May 2025. And Second Amendment has been notified on 13th August 2025, recently. So last month only the Second Amendment was being notified. Now this has a very, very important changes. First change is respect to presentation of financial statements. Second is with respect to the supplier financing arrangements. Even though it is under India 7, however, it is much more driven on supplier financing rather than cash flow statements. Then there are amendments on income tax, Pillar 2 tax models. Then there is 101 first time adoption, where the lease arrangement contains both land and building. Then it says that you can use transition date, facts, and circumstances to assess classification. In general, classification for lease is a financial, operating, or otherwise. It should be done as of the lease date. However, by 101 first time adoption, what it did is that you can use a transition date, facts and circumstances to assess classification. And then there is amendment in 105, 108, which are very small typographical changes. So we're going to focus more on the two very important amendments, that is current non-current liability. Second is supplier finance arrangement. However, before we focus on these two amendments, let us also look at and discuss about income tax Pillar 2 taxes. The concept of income tax 2 pillar is very recently, and it is very important for a large MNCs. Multinational corporations having presence across the globe and which are large in nature, having 750 million euro, having a 750 million euro of revenue, having presence or location across the continents, they are required to look at this particular concept. Now, what this concept talks about? The concept says that if some company opens a office or location in another country, wherein it is able to reduce a taxation which is not acceptable. We all know that in last few years there's been discussion and debate on Google saving huge taxes by opening a company in some other country. There are a lot of large MNCs having huge taxes. They are opening companies in other countries. So just to ensure that the companies don't play with the jurisdictions, just to evade the taxation part. This pillar 2 tax, which the concept which has been introduced by OECD. The OECD guidelines has come with pillar 2 rules. What it says that every company which is qualifying to be the part of this particular requirement, having a revenue of 750 million euro, should ensure that they will to pay minimum of effective tax of 15% in every jurisdiction in which they operate. So what I try to say is that the companies cannot live away from their obligations. Every jurisdiction from which they operate, there should be at least payment of minimum 15%. A lot of jurisdictions where there is no tax rate. So they are also trying to update their taxation structure, and they're talking about this additional tax rate part. So a lot of jurisdictions has already come out with these guidelines, and they are talking about 15% tax rate. However, there are still many jurisdictions, they have not amended their tax laws to talk about and asking about additional tax rates. So the issue was that the payment of these taxes also has impact on the deferred tax. Therefore, the discussion was that whether the company should create deferred tax or not. So that particular concept and question was being addressed by ISB, and they come out in discussion, and then they mentioned that Right now, this particular concept is due one. It is not still being like finalized. It is still evolving. So it is better not to have any default taxes which is going to be changing soon. So probably it will just give you exemption that uh, you may not produce deferred tax recognition. However, you have to provide extra qualitative disclosures. So that is what income tax pillar 2 tax is concerned. Now we're going to focus mainly on two parts. That is presentation of financial statements, one current, non-current, and then a supply financing arrangement. Index 10 events after reporting period is again on liabilities classification. That will also covered when we talk about current and non-current things. Let us first look at supplier finance arrangements. The supplier finance arrangement is a new guidance which is introduced in Index 7, that is Index 107. It is IS 7, now Index 107 is about financial instrument disclosure, and Index 7 is a cash flow statements. So there is a change in Index 7 and 107 with respect to this. Let us first understand that what this supplier finance arrangement talks about. Let us take example where a company has taken supply from ABC supplier. As per the credit period agreement between ABC supplier and company has to make payment after 5 months. ABC supplier wants to get payment fast because for them liquidity is big issue. So a company has entered into agreement with or arrangement with a financing part. Very financer gives a financing to supplier. In that case, for example, purchase is made for 10 crore rupees. The company has to make a payment of 10 crore only. So for a financing arrangement, even though supplier has taken a financing from a financer, supplier may have done some discounting, supplier may have bear some kind of finance cost. How, as far as the company is concerned, company is required to make only a payment of the invoice price. So the question here is that how this to be recorded. So analysts reached to ISB asking them to provide some clarifications on the classification of these liabilities. Long before, ISB looks at that agenda and then mentioned that there is no need to provide additional clarification for how to classify the liability if the arrangement is covered under supplier finance. Because they mentioned that existing Index 1 and Index 109 provides you adequate principles, and you to just apply the principles provided in Index 101, 9 and 1, and accordingly you decide that how to classify it. So they say that we are not going to give you any additional guidance as far as supply financing concerned for how to classify. So when I say question how to classify, it primarily means that whether that particular item will be treated as a trade payable or it will be treated as a financial liability, or in financial liability either as a borrowing or other financial liability. So the confusion was that I have not taken finance. Finance is taken by supplier. I am going to pay exactly same amount which I am required to make payment to supplier. So is it what is the transaction, how to disclose? So when ISB says that we're not going to give you any additional clarification that whether to classify it what, you to apply the principles of IS 1 and IFRS 9, and then you to do the requirements. So then they again approach ISB saying that Fine. We understand that you're talking about classification to be gone by IFRS 9 and IS 1. However, what about the disclosure requirement? Now, why this was crucial? It was crucial because I have a trade payable of 100 crore rupees. Out of trade payable of 100 crore rupees, I've entered into supply finance of 50 crore rupees. Out of 50 crore rupees, 10 crore supplier have opted for these arrangements. Now, when I disclose my aging of trade payables, the lot of suppliers where aging is more than 3 months. However, my obligation is not to supplier, it may be to the lender. So there's a need to have additional information. So at least analysts can understand that whether the company is having a supply finance arrangement or not. On that front, ISB agreed to discuss and consider this agenda point, and then they issued amendment under India 7, IS 7, and IFRS 7. So for us, it is India 7 and India's 107. So basically, here we may have to look at there can be a possible classification now. Company uses a bank arranged supplier finance for raw material payments. Earlier, it was classified under trade payable without any additional disclosures. Again, I won't say it's a change because, as I mentioned, that the ISB has not made any amendment a classification part. How it only requires us to have a critical evaluation. Probably on critical evaluations, we may conclude that the classification may be different. How you to provide additional disclosures. So, effective date and transition date, it is a period beginning on or after 1st April 2025. The exemptions are, it is not applicable for comparative, it is applicable, not applicable for interim period, and beginning of the period not applicable. So that means what? For a quarter ended 30th June, 30th September, 30th December, for this interim period, the supplier financing arrangement is not applicable because it provides of exemption in interim period. The first date on which this is going to be applicable is 31st March 2026. On that date, if a company has obtained a supplier financing arrangement wherein few other suppliers have obtained that, then we do provide the disclosure thereof. Let us look at definition and the scope. Supply finance arrangement, also called supply chain finance or reverse factoring, it involves finance providers paying suppliers on behalf of the entity, allowing for extended payment of terms for entity or early payment for suppliers. So this is what we discussed earlier, that the supplier finance arrangement is nothing but when supplier in a position to get earlier payment for company, no extra cost, they can still get the extended period. If that is the situation, then it says that you to provide the disclosure of this arrangement. You provide terms and conditions of arrangements to disclose at the beginning and end of each reporting period. Carrying amount of financial liability that are part of supplier finance arrangement and line item in which it is presented. Out of the above carrying amount of financial liability, which is part of SFA, line item presented balance sheet for which suppliers have already received financing arrangement. So I have 100 crore rupees of trade payable, out of the 50 crore has for which I've entered to supply finance arrangement. So first disclosure is about 50 crore for which the company has entered into the arrangement. Out of 50 crore, 10 crore has already obtained financing based on this arrangement. So that also need to be disclosed that out of this 50 crore, 10 crore has obtained, and then under which line item of balance sheet this amount is disclosed. That is to be provided. Potential financial effects. Liability related to supplier finance may be presented separately or reclassified. If so, it may impact ratios such as ratio and equity ratio, and it is may experience changes in working capital and cash flow presentation, affecting financial analysis and comparability. So that is what is being primarily talk about this part. So now let us look at the classification of liabilities under Ind AS 1. So before that, let me just again give you a brief understanding about why this is relevant. First, we discuss a point in case of supply finance arrangement. It is not giving additional information for classification. We need to apply Ind AS 109 and Ind AS 7 for that. So whether the financial liability should be de-recognized or not, it should be recognized only when the obligation is discharged or concluded or expired. Only when the obligation is discharged, expired, or concluded, thereafter you have to de-recognize financial liability. Why this is relevant? This is relevant because trade payables in my books of accounts, whether I have to de-recognize and whether I have to recognize borrowing or other financial liability, because particularly what happens that I said I have taken a goods from supplier XYZ, payment of 5 crore is payable to XYZ. However, XYZ have already taken the loan from lending partner ABC, and I have to make the same amount to ABC. So here it talks about give disclosures. So what is to we need to look at the terms and conditions between the lending partner and us and supplier lending partner. Whether lending partner has recourse to supplier in case if we fail to do it. So extinguishment of liability happens. When extinguishment of liability means trade payable is extinguished only when my liability to supply is being uh, gone, and then I'm only liable to the lending partner. And if that is so, then is it a borrowing or other financial liability? Now the question is that the borrowing is not defined. Ind AS 1, which provides presentation financial statements where the word borrowing is used, and Schedule 3 Division 2, which talks about borrowing. They both do not provide a definition of borrowing. So whether the financing arrangement, supply finance arrangement, is it a part of borrowing or not, that is not defined. So we need to evaluate to come to conclusion that whether it is qualified as borrowing or the financial liability based on terms and conditions, and accordingly the classification need to be done. So this is overall summary as far as that is concerned. And now let us look at one very important part, that is Ind AS 1 amendments. Classification of liabilities, Ind AS 1. Now, before I talk about this thing, first let us understand that Ind AS 1 provides you the guidance whether the liability is current or non-current. Liability is current if then it is expected to be settled within 1 year from the reporting date. Liability is current if it is expected to be settled within its operating cycle. Liability is current. It is unconditional right to defer settlement of liability. There is no conditional right to defer settlement of liability for more than 12 months. Then liability is current. So there are three main important ingredients. First and foremost, let us talk about right to defer. It says if there's no unconditional right to defer settlement for more than 12 months, then it is a current liability. However, if there's an unconditional right to defer settlement of liability for more than 12 months, then it is a non-current liability. The word which is used was unconditional. Now, what do you mean by unconditional? It was very difficult to say anything unconditional. In India, particularly, in a lot of countries in the world, there are so many covenants are there in the agreement. Like you may have to provide a stock statement, you have to see that your data equity ratio is 2:1, you have to see that this capital is introduced. So a lot of covenants and conditions are being provided in loan agreement. Now, when you say unconditional right to defer, means if some of the condition is breached without conscience of anybody, are you able to say that you are going to defer it? I think it is so difficult to say what is unconditional. So the first amendment is that the word unconditional is been removed. So now only there is a right to defer settlement. If your right to defer settlement of liability for more than 12 months, in that case, it is a non-current liability. Second very important thing was on covenant testing. Covenant is condition. So what happens that every agreement, loan agreement would have a lot of covenants are there. Sometimes covenant may be breached. Covenants like the capital infusion, covenants like submission of the stock statement, covenant like and infusing capital, right? So there are a lot of covenants which may breach. If you just look at India's one or IS one in the original format, it says that if it's a breach on or before the reporting date, then liability is current because even though it is a non-current liability, how if the condition is breached, then it becomes current because it means you are required to pay money immediately. However, if the breach is waived, whatever the condition which was there, which was a breach, was waived before reporting date, then it will still continue to classify as a non-current. The question which comes to mind is that if the waiver is obtained after reporting date, but before financial statement authorized to approve, in that case, there is India's carve out. Now, India's carve out is what? What is the difference between AS, India's IFRS is called India's carve out. Under IFRS IS 1, it says that any waiver of a covenant that is breached obtained after reporting date but before financial statement authorized to issue are called non-adjusting event. So the events can be adjusting event or it can be non-adjusting events. If that event happens after reporting date, then as per that it is called non-adjusting event. It requires disclosure only. However, under India's carve out, what we mentioned that it is a non-adjusting event or it is an adjusting event. Why? We said you can still classify as a non-current liability. Both in India, particularly, having the breach of the similar kind and waiver of the breach after reporting date before authorization approval is a normal case. So you can still continue to classify as non-current. It won't be classified as current because if it classifies as current, it will completely change the ratios. Because in practice, these breach are not so much critical. However, still they have legal right to demand. So that was India's carve out. Now, what is done that India's carve out is still being there. The only thing is that they have added to provide disclosure of this breach and which is being done in the financial statements. However, one very important thing is that there is again additional change which says that from 1st April 2026 onwards, This carve-out will be removed. So for accounting period beginning on or after 1st April 2026, even though the breach is waived after reporting date, but before financial are authorized to approve, that particular will be treated as a non-adjusting event and it will be classified as current liability. So that is going to be removed from the next year. As far as 25-26 is concerned, for 2026 you still enjoy the interest carve out and you can still continue the non-current with the disclosure requirements. From next year onwards, please ensure that it won't be the interest carve out. You have to classify it as current. So that is something which is critical for as far as the companies in India is concerned. So comparative things, classification liabilities. First was right to defer settlement of liability. Now the amendments which is covered under August 2025 of second amendment, it actually covers two amendments of IS. First amendment was done in IS in January 2020, where they modified and removed the word unconditional. Second amendment was done under IS 1 in October 2022, where they talk about covenant and its compliances. So, after amendments, what will happen that the right to defer settlement must exist and should have substance at a reporting date, not necessarily unconditional. Impact of covenants before amendments, waiver after reporting date is allowed with non-current status. You have to provide additional disclosure for 2026, and from 1st April 2026, the class is current. Future covenant compliances, it is less explicit but generally considered. However, post-reporting date do not affect classification, but if you just look at this point, and then you were to look at the report disclosure requirements. However, from April 2026, you need to see that it will affect classification. The disclosures are required. It is expanded to include risk of breach and future covenant test. So that is what is covered under the comparison. To take few moments of you to take you ahead with respect to the IFRS 18 because it is bound to come very soon in India. Probably it may be a couple of years still left to have India under 18. But this IFRS 18 or India under 18 which can come into India, it is talking about a very important change. It is talking about change in the presentation and disclosure requirement. Change on the face of profit or loss statements. So I'm just giving you a brief overview of what may be the profit or loss statements after a couple of years to have just a bird's eye view of what's going to happen in the future. First is that the subtotals are being defined in operating, financing, investing. Now let's just look at these three terms. You may understood that it is one of cash flow statements. Well, operating, investing, financing in the cash flow statements. Similar terms are being also taken in a profit and loss statement. So the profit loss statement, what we see currently today, it is going to be different, but we have additional line item of operating profit, also additional line item of a profit before like final profit. Plus, there's additional MPM, that is management defined performance measures. MPM are disclosed in a single note to the financial statements as subject to audit. So let us now look at illustrating the statement which is going to be there. If you just look at here, we have operating, investing, and financing. These are the new categories. we have operating profit loss here. Then we have profit or loss before financing and income tax. It's a new subtotals which is going to be there. And then there's financing where we have income, expenditure, everything is here. And here is income from investments, interest income from cash and cash equivalent, plus if you have any equity accounted investees, it will come here, not at the end. Today, any share of profit loss associated from associate is a part at the end line item. Now it is a part of earlier line item in a part of financing part, investing part. So, friends, with this, let us talk about the few important key takeaways. One very critical part is India's 21, which where we discussed that it talks about where this currency is a non-exchangeability. It provides you guidance of how to determine non-exchangeable currency. And step 2 is that if the currency is a non-exchangeable, how to determine spot exchange rate. Second very important thing is that India's amendment, Second Amendment Rules 2025, 13th August 2025, where two important amendments are there. One is supply finance arrangements, where it requires you to provide additional disclosures about carrying amount, line item, and maturity period. Another important is about current and non-current liability. Unconditional right to defer. The word unconditional is removed. What is settlement is defined, and it also provides guidance of covenant which has been complied with it before reporting date, after reporting date, before financial authority to approve. Then it says that 25-26 you can still continue to classify as non-current with additional disclosure requirement, but from next year onwards, from 1st April 2026 onwards, it will be treated as a current liability. So I think that's a very, very big important changes for all of you to understand. And friends, thank you everyone. Yes, we do have last couple of minutes for you to have any question answers. I'll be happy and glad to cover your questions. So transfer to the moderator for taking the head.
Thank you, sir. We have some questions, sir. First question is, please tell whether India is adapted from IFRS, whether any changes in IFRS is adopted concurrently in India as. Secondly, whether all the India as is mandatory to be followed by all companies.
Yeah, so basically, first very important thing is IFRS and Ind AS, they both are a little different, but Ind AS are based on IFRS. So 99% of IFRS is done in Ind AS. There are only few carve-outs are there in Ind AS. Carve-out is nothing but the difference between IFRS and Ind AS. Now these carve-outs are required to adapt to the economic characteristics and conditions of every country. So in India, we have done few small handful of carve-outs, and they are the difference between IFRS and Ind AS. Second question which you asked about applicability, Ind AS is applicable to all listed companies, and for all unlisted companies, if the net worth is 250 crore or more. Additionally, every subsidiary, associated joint ventures of a companies which are covered in Ind AS are required to comply with Ind AS. Plus, voluntary Ind AS is being allowed.
Okay, sir. Another question is, sir, will existing supply finance arrangement as 31st March 2025 have to be reclassified with effect from 1st April 2025 and hence stated under financial liability under Ind AS 109 and not as a trade payable. This will help comparison with figure as on 31st March 2026.
So basically, for a supplier financing arrangement, first very important thing is that it is effective from 1st April 2025. So 31st March 2025, there's no question at all. It is already being finalized, freeze, approved, issued. It is effective from 1st April 25. However, I also mentioned that for interim period also there is exemption. So now for a listed company, the balance sheet will come on 30th September 2025. For that also there is exemption. So next date is the 31st of March 2026, practically for which you're going to look at these things. However, please ensure that these amendments don't talk about revised classification. It only talks about giving additional disclosure requirement. It says classification will still be governed by the similar principle which was there earlier. So it is more focused more on providing you additional disclosure requirements. However, you do again assess and test this new information, and then you do look at this classification and disclosure on March 30th March 2026.
Okay, sir. Thank you. No more further questions, sir. Thank you, sir. On behalf of the CP committee, I sincerely thanks for discussion on recent India AS amendments. Sir, your clear and explanation have greatly enhanced your understanding. I also extend my thanks to all participants and organizing team for their support in making this program success. Jai ICI, Jai Hind, Jai Bharat.
Thank you, everyone. Bye. Have a good day.
Uh, CP committee would like to thank both the faculties and Raja sir, the moderator for the webinar. For
Thank you,
the
Kushal, for all the smooth
valuable
coordination.
input.
Thank you.
Thank you
Thank
so
you.
much.
Thank you.
Sanket ji, yeah, you can end it now. Thank you.
Recording stopped.